I'd like to call Professor Eric Scharling. He's the convener of this event tonight, and he'll be talking us through what is going to be happening tonight and why we are all here.
Cross-border banking in Africa is a big issue. It has both positives and negatives. The upsides are financial inclusion, financial deepening. However, those are new developments, so there are also risks that need to be addressed by regulators. And this issue will be addressed tonight by Professor Thorsten Beck.
Well, we know that if you go north from South Africa, most financial systems in sub-Saharan Africa are small, they're costly, they're not very inclusive, and they have relatively shallow markets. There has been lots of progress over the last couple of years, but there's still much more to do. And cross-border banking, in our opinion, can be part of the solution. There are also new risks coming from cross-border banking in terms of contagion effect, in terms of fragility. And I think there's obviously each region, each continent is different, but I think there is something to be learned from the global financial crisis, from the Eurozone crisis, also for as we go forward in Africa. But let me maybe first show a little bit about where we stand in Africa, because it's actually a pretty nice picture, a very positive picture. There has been a lot going on in African financial systems over the last couple of years. The indicator, what we kind of like to use, these indicators of financial depth really point upwards. And even during the crisis, even during this 2008-2009 crisis, they still pointed upwards. And if I extended this graph now to 2012, you would see further trends upwards. There has been more inclusion, there has been more innovation in South Africa, for example, but also in Kenya, mobile banking. So new forms of delivering financial services, new forms of reaching out to previously unbanked population. This is Africa in comparison with the rest of the world. And as you can see, so the darker, the more foreign banks are in the country. And as you can see, Africa has been also traditionally a continent of cross-border banks. As you can see, there has been a sharp increase in the number of countries they have been expanding to. And if you look at now kind of the results, you see a bank like EcoBank, I think it's 35 countries by now, but also Standard Bank covering most of Eastern and Southern Africa. Now, some of these banks have become actually quite large relative to the economies, the financial system of their host country. So they have actually become systemically important outside their home country, in the host country. As you can see, just two examples, EcoBank and Standard Bank. The answer right away, is cross-border banking bad, good or bad? I can give you a clear answer to that. It all depends. Now, and if you look at it, I mean, you can, any theorist can build a nice theoretical model telling you it's good or bad. On the downside, foreign banks are often accused of focusing on cream skimming, on focusing on the richest of the rich, and just making large margins there, but not catering to the rest of the population. However, there are also benefits to it. Cross-border banks can bring in new ideas, new innovation, more competition, for example. They can also bring resources if they acquire failing banks in the host countries. They can also actually bring certain stability to a financial system by helping mitigate domestic shocks. You had the foreign banks being really part of the reform, macroeconomic and financial reform package in these countries, ultimately helping to deepen the financial system, increase inclusion. Why do we regulate banks much more than we do other industries? Well, because they are very important for the economy. They are kind of the lifeblood. They provide the lifeblood for the economy, money, credit. And also, if a bank fails, it doesn't just affect the stakeholders of the banks themselves, which are already many, especially if we talk about depositors, but it can affect the rest of the financial system, and it can affect the overall real economy. And typically, when banks take risk decisions, they don't take into account what we call the externalities of bank failure. So there is by per se, is already a big argument for regulating banks. There is lots of space for improvement on the national level. In terms of cross-border cooperation, it's going to be a long process, and it's a very dynamic process. Because again, the cross-border, the population, the structure of cross-border banking in Africa is very much in flux. It is a trend towards more integration, more banks expanding across the continent, but actually also some banks even changing headquarters or changing their main investors. And finally, I think given the picture I showed you earlier with some of the large African cross-border banks really spreading out across the continent, I think more focus on their role, a positive role, but also the potential fragility if something goes wrong with them, I think is really needed. And there are a couple of banks, and again, I don't want to name any of them specifically, but there are some that might raise some eyebrows in terms of risks that come from them.
What I would like to know is, if we think about the global financial crisis, the regulators were way behind the curve, unable to understand financial products, unable to understand financial innovation. So you could say that the banks were running circles around the regulators. So a big gap between required regulation and actual regulation. So how big is this gap in Africa?
If you compare Europe with Africa, I think the benefits still outweigh by a lot the risks coming from further financial deepening. I mean, what we've observed in Europe, any financial deepening in Western Europe at the end were basically mortgage credits, or were, that's on the lending side, or were derivative products, trading, often proprietary trading for the banks. So not exactly benefits directly for the productive real economy. And then maybe it's also for that reason that if you look at this finance and growth literature, the biggest effect comes in the lower and the upper middle countries. And that's where exactly Africa would fall in. So I think the benefits of financial deepening, of which cross-border banking is an important part, are so much bigger than in Africa than in other parts of the world. So that's, I would really rather err on the side of deepening rather than on the side of risks, without ignoring the risks, obviously.
East and Central Europe were virgin grounds for banking because there used to be a command, planned economy type countries. And clearly when the immigrating banks went in there, they were received. And what they had was the first thing on the ground, and so it worked. Unlike Central America and Africa, where these Western banks had presence. Clearly, what we need to do for cross-border banking to be of the desired effect that the professor and his co-authors are looking for are two things. One, to minimize the foreignness that these immigrating banks feel when they go to the host country. And two, to draw, deliberately, concertedly draw from them what would be beneficial to the host country. I found this piece of work you're doing very, very useful in helping us in Africa and other developing countries think about how to leverage the benefits of cross-border banking.
I would say the one big comment, and if you have to ask yourself the common sense question on cross-border banking and what's driving it, it's the customer. And so we have to put something at the center of this presentation. I would say that the customer is the largest voice. As the flow of people, goods and services increase across the continent, it's only natural that not only banks, but companies in fast-moving consumer goods, mobile and telecoms and other industries have to follow their customer. Now imagine cross-border banking, in which whether you're a corporate, an SME or a multinational corporation, or many of you who are from our neighboring African countries and European countries and North America and Asia, could seamlessly walk into a bank and you are recognized as a customer, SME, corporate, multinational and individual. You bank seamlessly, you're recognized and you get serviced. With the flow of information in the world driven by technology, the Facebooks, etc., it's only natural that an increasingly diverse and discerning consumer is expecting that of the banks. And therein lies the power of Pan-African and cross-border banking, but also the challenge. Because if you look at the large global banks, and certainly the ones emerging from sub-Saharan Africa that are moving in, you're moving in as a cross-border bank to better service your customer. A number of the African countries, including South Africa, made it through the global financial crisis on even keel. I think it's testimony, again, to some of our regulators in Africa really thinking through this issue of risk, this issue of resilience in the system.
You know, put the customer in the middle. Right, that's of course what you want, but not just from the bank, but also from the supervisor. Because what's ultimately the role of the supervisor is to protect the customer. So I don't think there's an antagonism, but at the end of the day, the objective is very similar. It is, you know, why do we bank, or why do we have banks? Because somebody needs a banking service. And that somebody needs to get the service, but it also needs to be protected, that it's a service that he or she can trust on. You're not going to lose your money, and you're not going to cause any damage to the economy. You know, the balance is somewhere in the middle. It's not whether financial deepening goes first and then supervision catches up, or first you need to have the perfect supervisor and regulatory standards. They need to go together. And I think what we're seeing right now is that the Pan-African banks have developed quite strongly. They are systemically important in almost 50% of the countries that they are resident in their host countries. And the supervisory capacity is not there yet.
Think of the effort, particularly if you're a global entity, be it a European bank, be it any of the sub-Saharan banks, of thinking of entering a new market, the market sizing. And one of the things that the professor put up was a graph of the sub-Saharan banks versus the international. Mm-hmm. I think you have to distinguish between the what the intention is versus the how. The what is, we want to enter a new market. The current trend is that Africa has several of the fastest growing economies in the world. As stress is felt in other markets, it's seen as a go-to market. But there's different ways of approaching it. I think there's a model in which there's significant investment of skin in the game, of building out branches, having infrastructure, particularly making banks local. So even though you're global, you have the local presence of locals really being the talent force and driving, versus this model of helicoptering in to the point you made of, you called it cream skimming, versus others say cherry picking. On the other hand, there's also what we call the bottom-up aspect of cross-border banking. And let's talk about remittances as an example. If you look at the African statistics in terms of remittances, I think over 2013, $55 billion US plus minus is the remittance pool targeted for Africa. But if you look at that, that is an essence of what cross-border banking is about. There is a community out there that is looking to get funds, be it urban to rural, be it off-market, etc. And there's an incredible ecosystem.
For those that are in, you may not play in the field that necessarily want to play. You are restricted. I've had occasion to talk to some of the other multinational banks that are in here. They are hemmed into maybe attending to their corporate clients or getting involved in international banking while they are here. And if you want to play at the lower end where you reach the unbanked and the license precludes you from doing that, that's an impediment you can't do anything about. The second part is you want to go to Timbuktu and start a bank where you reach SMEs and all of that, but you need infrastructure that you're already used to, and that infrastructure or the set of infrastructure is not in place. You obviously will be impeded from going in there. So for me, those are natural impediments that will militate against cross-border banking.
Whatever's good for the customer is good for the industry, right? So competition in general is healthy for a sector, right? And I think we should welcome that. I think any business that's in the game of better servicing customers, which is what you should essentially be about, should welcome the competition and learn from industries. Getting the app of your entity, of your financial service, whatever financial system that may be, onto a device, onto mobile, then becomes an enabler, an enabling ecosystem for financial services viewed from that position in terms of getting those apps that are quite active and engaging, of servicing the customer from insurance, from moments in their lives when they have children to get that timing right. And so technology can often be seen from both perspectives of what it means.
In many of the smaller African countries, you get the capital city, Everything else is small townships, and so you have sparse population. And you cannot get the kind of population density that will support a bank to be profitable and provide you the kinds of services you need. And Equity Bank actually got onto that problem as a way of solution by using mobile banking, the ICT technology to actually create a virtual population density that then allowed it to provide banking services at an affordable price for the customer. What happens to a bank that extends a loan to you? Well, I must have a recourse if you default on the debt. And the property laws, the legal environment must be one that allows me to grab onto the collateral. We will have further problems with that in Africa. You may get that collateral and then you go to the secondary market. There's no secondary market for the collateralizable asset that was given to you. What recourse do you have? Nothing. What does that take us to? Well, it's not just banks or stock markets that are going to provide the needed financing for Africa. Other financial services, institutions, say, I just had a study done where leases and trade credit were found to be very significant, close to 30% in funding activities, economic activities in Africa. What do we do with those? We must begin to think about institutions that will deepen those sources of financing. So we cannot just look to banking and stock market as the only source of getting development funds.
The competition is healthy, but we should never forget that capital being agnostic, we also have to build a value proposition, be it Africa Inc. or regionally or as the various countries, to attract FDI, which is absolutely fundamental to balance things. So you look at things like balance of payments and the vulnerabilities of economies, which all depends on the overall bigger picture. These are neither good or bad things. It all depends, as the comment was very much made, on how we set up that ecosystem. So to me, foreign direct investment does not just bring capital, it brings expertise. It allows us to link to other markets. How we use that is dependent on us as communities in terms of shaping that. And that, I think, regulators are very important in terms of setting direction and setting that tone. And so I think FDI is critical, but it's up to local markets to manage that and to make sure that the benefits accrue to people. And how do those benefits accrue? It is through the sharing of intellectual capital, the sharing of systems, the training of folks. And I think regardless of the industry or sector, whether it is South African or other African banks going internationally to new markets, you have to fundamentally have an understanding of the markets that you have. You have to embrace the communities that you're in. Ultimately, markets will decide. Customers will decide whether the offering you have will serve you or not.